Recently, I came across a fascinating theory in Australian property investment, the 18.6-year cycle. Many property agents claim this is the most important book on Australian property investment they've ever read. The Secret Life of Real Estate and Banking. The author, Australian economist Phil Anderson, researched over 250 years of historical data on the US property market to identify a striking conclusion: an 18.6-year bull and bust cycle in the property market. This work was inspired by British economist Fred Harrison's book, The Power in the Land, in which Harrison analyzed 350 years of the British housing market and also found the 18.6-year cycle. Could this really just be a coincidence? This megacycle theory is now gaining traction. After extensive research on this topic, I found it very interesting. Following the theory, Australia's property market could significantly decline in 2026. Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The core idea behind this theory is quite simple. The economy follows cycles, and since the property market is a part of the economy, it also has its own cycle. If you can grasp this cycle, you can predict the broader market direction, which can support your buy, hold, sell strategy in property investment. According to this theory, the current property market cycle started in 2012, right after the global financial crisis, when people were still weighed down by pessimism and governments were eager to boost the economy. When applying the author's analysis of the US property market to Australia, there are numerous similarities. Between 2012 and 2019, for example, Sydney and Melbourne quickly shifted into a rapid growth phase after the crisis. Over this 7-year period, Sydney's property market rose by 73% and Melbourne by 55%. Many individual houses even saw price double. During this 7-year mini-cycle, the government supported economic development, banks relaxed credit, and this stimulated growth in both the economy and stock markets. This growth continued until the market hit a peak and entered a brief adjustment period. According to the theory, this adjustment period for the Australian property market occurred from 2019 to 2021. Each adjustment phase, however, is triggered by different events. Past examples include the 1991 recession and the 2000 dot-com bubble. This time, it was the 2019 global economic slowdown and the 2020 pandemic. Roughly 35 to 40% into each 18.6-year cycle, a crisis tends to occur, leading people to offload assets to minimize risk. Between 2019 and 2020, global property markets generally declined, with Australia's dropping by 2.3%, though other countries were hit much harder. Soon after, however, central banks worldwide intervened, injecting massive liquidity, which sparked a rapid rebound. Australia saw a record 25% price increase in a single year. Those who purchased property during the pandemic saw returns of 50 to 100% within 2 to 3 years, depending on the property type and location. While different cities vary, overall property prices in Australia continue to climb. Even though prices are high, certain cities and regions remain affordable, leading to faster growth rates than in major cities. In the second 7-year period of the 18.6-year megacycle, the property market generally trends upward. Cities like Perth, Brisbane, and Adelaide experienced substantial price hikes, with some properties doubling in value, which propelled Australia's property market overall. Toward the last 1 to 2 years of this second 7-year period, we often see a phase known as the winner's curse, where asset prices surge dramatically. By this point, investors who have finally been convinced by the market trend flood into assets like stocks and property, driving prices even higher. Many of these latecomers are people who had previously stayed out of the market, often without seeing much profit. For example, someone who invested in Adelaide in 2012 and sold in 2019 likely made little to no profit. These investors eventually changed their perspective and entered the market. During this period, rising asset prices and a wealth effect make people feel richer, prompting spending on things like cars, luxury goods, and corporate investment, creating a booming economy until it all comes to a halt. The first sellers begin to leave the market, followed by others who sense danger, leading to a rush to exit. In the stock market, this is called the theater theory. In a crowded room, only those who leave first can escape, while the rest are forced to push through each other to reach the exit. The property market's response is slower, as selling a house from listing to final payment takes 3 to 6 months, but the trend is similar. In the 18.6-year cycle theory, the 1 or 2 years of the winner's cycle are considered the most dangerous. Timing this phase well can lead to big profits. Missing it can result in huge losses. In the upcoming economic or financial crisis, those who invested late may see their wealth shrink dramatically. Afterwards, the market will enter a new 18.6-year cycle. The theory predicts the current cycle's peak to be in 2026. This is a general overview of the mega cycle theory. So what are the specific issues with this theory, and what should Australian property investors keep a close eye on? Number 1. Digging deeper into the author. Phil's book was published in 2008, right around the time of the subprime mortgage crisis. However, the ebook version was available for download on his website as early as 2002, meaning the book was likely written around 2000, making it 25 years old now. One of my questions is whether this book includes data from the last 25 years. Phil is also the founder of 2 companies that provide business, real estate, commodity cycle forecasting services. You could think of it as a prophetic service or even a fortune-telling service. Personally, I find it doubtful that anyone can truly know the future direction of the market, which raises questions about this theory. Number 2. Examining the book. This book talks about the US property market data from before 2000, covering a 250-year period and ultimately identifying an 18.6-year cycle. But is this relevant to Australia? The data doesn't come from Australia, yet it's being applied to guide Australian investors, which seems quite far-fetched. It's similar to when the investors in China before the pandemic focused on buying small apartments in city centers. Trying to apply that approach to Australia would lead to losses. Real estate is highly localized, with each country's political systems, economy, social culture, geography, and immigration policies being unique. Consequently, the investment dynamics in each real estate market vary greatly. For instance, Robert Kiyosaki's rich dad poor dad property investment theory is essentially useless in Australia, as it is tailored to a specific period in the US market. Even within Australia, each of the 8 major cities has distinct property markets. So, should we expect the 18.6-year rule to apply uniformly across 15,000 plus suburbs, councils, cities, and states in Australia? And what about different market segments like apartments versus houses? Number 3. Reader acceptance. I checked the sales data of this book, and frankly, it isn't impressive. The book by the British economist who inspired Phil, Power in the Land, has even poorer sales. Very few people have read it. An interesting phenomenon here is that while the book is about the US market, nearly all the discussions on social media and YouTube about it come from Australian property agents, which is quite fascinating. Number 4. Digging deeper. During my research, I came across a video from an Australian property agent discussing this 18.6-year cycle, in which he showed a chart without giving any source, presenting it as his own. I tracked down the original chart, which was first shared on X by an Australian from Brisbane. His business is essentially drawing people who are interested in trading cryptocurrency into his community, charging fees upon entry and likely further costs once inside. He mentions investing in real estate in his bio as well. I don't fully understand why some Australians are so keen on pairing real estate with cryptocurrency. Real estate is a stable long-term investment, while crypto is highly volatile and speculative. These 2 asset types are at opposite ends of the risk spectrum, so it's hard to imagine someone interested in the stability of real estate also seeking the extreme swings of crypto. It strikes me as a bit split-minded. Studies from the University of Toronto and the University of Miami suggest that people who hold and especially profit from crypto are more likely to display dark personality traits, such as narcissism, Machiavellianism, psychopathy, and sadism. If you know any crypto enthusiasts, check if they fit this profile. Another Chinese-speaking buyer's agent simply translated an English property agent's video on the mega cycle without crediting it, presenting the content as their own analysis. That's hardly proper conduct. Number 5. Patterns of the theory's popularity. When is the 18.6-year theory most popular? When the property market isn't doing well and short-term expectations are gloomier. At these times, people lose confidence. The prices will keep falling and find it difficult to make buying or selling decisions. They start looking everywhere for information to predict the future. Property agents with fewer clients during these slow times see an opportunity to give people confidence. So they bring out this old book, paint a rosy picture of the future, and say, don't worry, prices will go up again. This was the case after the 2008 financial crisis, and it resurfaced after the 2022 market decline. The same trend has emerged in the past year as a few property agents have started prompting the book again. In my opinion, the main takeaway from this theory is more about providing emotional comfort than practical guidance. In my view, the 18.6-year cycle doesn't apply to Australia because the fundamental data doesn't come from Australia. Furthermore, Australia has different market cycles depending on the region, which don't align with an 18.6-year timeline. It's more like a dose of motivational talk, and it's primarily promoted by property agents to potential buyers. Even if the 18.6-year cycle were applicable, it wouldn't affect our investment philosophy and also property strategy for our Vision members. Our approach is based on market rules of number 1, short-term fluctuations, long-term growth. Number 2, prioritize trends over timing. 3, buy more, buy early, hold longer. Number 4, manage cash flow thresholds. And number 5, diversify across states. When these principles are in place, any impact of the mega cycle theory becomes negligible. Regarding any cycle theories, you should approach them with caution. Personally, I never base my investments on someone else's cycle theory because if it's wrong, the losses aren't borne by the economists. They fall on our paying Vision members. When members join us, we start with a 90-minute strategy session with our advisors to understand their current situation, future goals, and to create a tailored 10 to 20-year investment plan. This includes selecting the right timing, entity, property type, and strategies for loans and fast-tracking their financial goals. Depending on their risk tolerance, we may recommend new properties, existing properties, commercial properties, or even property development trusts. So far, none of our Vision members has bought a money-losing property. Making this video doesn't particularly benefit O's property strategy. It's more about reinforcing our mission to help property investors see through the clutter of information and make informed decisions. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.